who spends a significant amount of time working with condominium associations and cooperatives. A few housekeeping items before we get started. Use the questions pane in the GoToWebinar dashboard to submit any questions or comments you have as we proceed through the presentation. We will either address them as we go or at the end. We will keep the presentation to a maximum of 1 hour. We will end by 1 o'clock. At the end, there will be a slide with the presenter's contact information. A recording of the webinar, as well as a copy of the slides, will be placed on our website, www.wgcpas.com. You can also find recordings of past webinars there, along with other resources for community associations. Please keep your eye out for additional webinars that we have coming up. Throughout the presentation, we'll have a few polling questions. They'll pop up on your screen, and we ask you to please vote for your answer so we have a sense of where our audience is at. Finally, we welcome your feedback as to suggestions for future programs or comments on this program. Moving on, today's program will be focusing on the budgeting challenges that associations are facing. Our program is basically divided into 2 parts. Part 1 is what and how to budget, and Part 2 is how to collect those monies from your unit owners for what you budgeted. Our presenters are Amanda Brady from Wilkin Guttenplan and Jeff Surratt from Greenbaum, Rose, Smith & Davis. Amanda is a manager with Wilkin Guttenplan. She has extensive experience working with community associations and co-ops, providing them with accounting, audit, and consulting services. Jeff, who heads up the Community Associations Group at Greenbaum, provides numerous homeowners associations, condominium associations, and cooperatives with a full range of legal advice and services. Mr. Surratt has extensive experience in all aspects of common interest communities, including the transition of a community from developer to unit owner control, interpretation and drafting of master deed and bylaw provisions, promulgation of rules and regulations, together with a significant involvement with alternative dispute resolution procedures, and other matters necessary for the proper legal administration of a community association. So let's start with our first polling question. What is your role in the budget process? Please select 1. 1, I help prepare them, have a little experience in this. 2, I help prepare them, have experience just looking for some pointers. 3, I don't prepare them, want to understand it when presented. Thanks for responding. We're seeing the responses come in, and in a second, we'll see what our audience looks like. Okay. So 19% of you prepare them and have little experience in the budgeting process. 70% of you help prepare them, have experience, and are looking for pointers. And 11% don't prepare them and want to understand it better when they are presented. So at this point, I'm going to turn the mic or the telephone over to Amanda, and she'll give you an overview of what and how to budget.
Okay. Again, as Jules had mentioned, these are now challenging economic times. So we're going to go through, and the overview of what we're going to discuss is going to be some of the basic budgeting rules. We're going to talk about some special areas of concern, which would be items like bad debt, prior year deficits, snow, possibly Hurricane Irene has impacted you. We'll talk about the contingency line item. If you have a new replacement fund study, how you should deal with that, and your deferred maintenance funds. We're also going to discuss other sources of revenue and collections. So first, I'm going to start with some of our basic budgeting rules. When preparing your budget, you need to do your homework. And some of the things that you want to consider when preparing your budget, you need to determine what your current year estimated expenses are. So the first thing you'd want to obtain is possibly a general ledger from your management company. So this will include a year-to-date expenses, a detailed listing of those year-to-date expenses. The next thing you want to do is estimate the expenses for the remaining months of the year. So if you were to receive a general ledger from your management company, that may be through September 30th. But you know if you're going to have year-to-date expenses, you're going to have expenses for October, November, and December. So you're going to have to estimate the expenses for the remaining months of the year. So you should consider recurring monthly costs, remaining payments on contracts, or month-specific expenses, such as snow would come up in December and may not come up in October or November. When you take the sum from the detailed listing of year-to-date expenses plus the estimated expenses, that would be the amount that you may want to include in your budget. You also want to obtain contracts signed and in effect for the current year.
So, Amanda, when you estimate year-to-date expenses and amounts for next year, what are some of the issues that we should be aware of?
Good question. So for certain expenses, you need to remember that you can't just annualize 9 or 10 months of expense year-to-date. There are many seasonal expenses, as I had mentioned, which may have larger payments at the end of the year. For example, you may have snow in December. There may be irrigation shutdown costs that may occur in November. You may have fall cleanups in November. So there may be contracts signed and in effect for the last month of the year, and you may have special projects. So for next year, what you'd want to do is you'd want to consider all planned projects and sign contracts for your budget. Okay, so again, you want to obtain the contract signed for the upcoming year. So certain line items may be fixed costs based on the contract signed, but what you want to do is review the contract to see if the contract price includes the sales tax or if it includes a price adjustment, because a lot of times multi-year contracts include fee increases. You may have some planned work coming up, so if Hurricane Irene affected you and you need to do some landscaping, you know that in the spring you'll be doing some sort of planting. If you don't have a contract that's signed, you may want to obtain an estimate and include that estimate of the cost in your budget for 2012. Another good place to look would be your prior year audited financial statements. So when you look at those financial statements, they may help you get an understanding of what a full year expense is, and you want to make sure that you include all of those expense line items. Okay, so let's do an example of how you would deal with your budget. So if we were to go through landscaping expense, you would check your general ledger and see that your general ledger includes landscape expense of $74,900, which is all your contract payments to date. The next contract year calls for a 5% increase. And you also know that there's 2 months left on your landscaping project for $10,000 plus tax for each payment. The landscaper also informed you that fall cleanup would be approximately $30,000 due to the hurricane, but it's usually $20,000. So if you want to estimate for the current year, you would take the $74,900 plus your 2 payments of $10,700. That would be the $10,000 left on the contract plus tax, which equals $96,300. And then you'd have an additional $30,000 for the hurricane cleanup, bringing your current year expense to $126,300. Next year, what you would do is you would take the $96,300 and you would add the 5% increase. So you would come up with $101,115. And then since usually you have $20,000 of expense, but this year you have $30,000, you may want to budget an additional $25,000. Bringing you to $126,115, and we would suggest that you'd round that to $127,000. Okay. Next, I'm going to talk about some special areas of concern. The first area of concern would be bad debt. So as a lot of our associations have seen, bad debts have been increasing. So even associations that did not previously have delinquent issues are now faced with this.
So let's do a polling question. Polling question number 2. Have unit owner delinquencies increased in the past year or so? We'll catch up in 1 second on the screen. Sorry, we'll get there in 1 second. So, have unit owner delinquencies increased in the past year or so? Please select 1. 1, no, our unit owners in general are current in their dues. 2, increased slightly, no significant impact on cash flows. Or 3, increased significantly, significant impact on cash flows. I see that you are answering the questions. That's terrific. We'll give you another few seconds in order to vote. 1, no, 2, increased slightly, or 3, increased significantly. And let's see how you voted. 25% said no, our unit owners in general are current in their dues. You're the lucky ones. Some of you, 26%, increased slightly, no significant impact on cash flow. And almost half of you, the owner delinquencies have increased significantly, which has a significant impact on cash flows. So back to Amanda on bad debts, and we'll be talking later as to how to collect those dollars.
Okay, so you may be asking why would you want to budget for bad debt? The problem is that if unit owners aren't paying their maintenance fees, then you may not have the cash needed for operations. So what you want to do is by budgeting for bad debt expense, you're reducing the amount of billed maintenance fees that are available for operations. So when you're estimating the amount of current year fees that may not be collectible, what you may want to do is discuss it with your attorney what may not be collectible. You'd want to consider unit owners that are significantly in arrears. So you want to estimate potentially unit owners that are more than 1 year in arrears. You may decide that anyone who is in legal action, those are the people that you're going to estimate. If you have vacated units, you'd want to consider estimating an amount that's not going to be collectible from those units either. So in order to calculate the amount that may not be collected, you want to consider the annual maintenance fee. You also want to consider any late or legal fees that may be assessed to that unit. So if you know that you have a policy in place where you're assessing $10 a month to any late fees, then you would also want to estimate an amount for bad debts on those late fees. In addition, if you have any special assessments that are payable in the current year, you would also need to take that into account when you're considering your bad debt. The next topic is the prior year operating fund deficit. A lot of times what we've seen is that snow or even Hurricane Irene may have caused unanticipated expenses, causing associations to incur deficits that were brought on by unforeseen expenditures. So these prior year operating deficits must be dealt with in a subsequent year's budget. So things that you could do is include an additional assessment in your budget for the deficit. You could include a budgeted line item expense, or you could budget for a planned surplus.
So Amanda, what are some of the advantages and disadvantages of each one of those approaches?
Good question. Some of the advantages of an additional assessment or a special assessment could be where the extraordinary item, the additional assessment, doesn't impact maintenance fees. So the unit owners feel that they're still paying the same maintenance fees, but they know that they have this other assessment that will potentially go away in the future. What could also happen is that you could have the assessment payable over a shorter period of time to escalate the cash flow and get cash to the association quicker. The other thing is that it's obvious what the collection is for, so people feel that they got something for their money, and they see where the cash went to. If you include a budgeted line item expense or a planned surplus in the budget, the extra revenue will be built into the monthly fees that are collected, and it may be easier for the unit owners to pay over 12 months. So if you're an association that has a collections issue, you may want to spread out the repayment over 12 months because you're more likely to get those payments back. If the association has a large deficit, they may also want to budget for the deficit reduction over a few years, which will, again, make it easier for the unit owners to repay it. Okay, another very difficult item to budget for is snowfall. Since it's a very difficult item, there are a few things that you could do, including looking at last year. But what you'd always want to do is you'd want to budget more rather than less. And you always want to monitor carefully for any overages that you have. We previously presented a webinar on snow, which is on our website, and you can go back and you can reference the webinar at www.wgcpas.com. And then we come to Hurricane Irene. So Hurricane Irene may have an effect on next year's budget if you need to replace trees, if you need to do landscaping work, or do roof repairs, those types of items. So you may need to consider a line item for tree or plant replacement, but it could have also had an effect on your replacement fund. So if replacements are earlier than anticipated, what you may want to do is include an additional line item to budget additional amounts for replacement funding going forward, and then you'd want to do an earlier update of your study.
So Amanda, as a result of Hurricane Irene, associations may have to make a number of repairs to common elements. Is there any resource available to give guidance as to what should be charged to the replacement fund and what should be charged to the operating fund?
As a matter of fact, we just published an alert on this very topic. There are a number of things to consider, all of which are discussed in the alert. If you do not receive a copy, please see our website or email me, and I would be happy to forward it to you.
Great.
And lastly, one of the effects of Hurricane Irene may have been a current year deficit, as we talked about. So you may have excess expenses in the current year that may cause a deficit going forward, which you would need to include in your budget for 2012 to make up for some of those expenses incurred. And then we come to the contingency line item. So the purpose of a contingency line item would be if you have items that are unanticipated. For instance, if you have excess snow costs, or if you have unexpected repairs and maintenance in the association. So a lot of times we're asked, how much should we budget for on our contingency line item? We generally recommend that you would budget 3 to 5% of your total expenses before considering your replacement funding and your deferred maintenance funding.
So let's go to another polling question. We're moving to the topic of replacement funding. And the polling question is, how do you use the replacement fund or reserve study in your budget? 1, do you include in the budget full funding as recommended by the engineer? 2, do you include in your budget threshold funding as recommended by the engineer? Or do you include in your budget whatever you think you can afford? I see that you're voting, which is a terrific thing. We also want to encourage you during the course of the webinar that if you have questions, please use that panel to email us the questions. So another couple of seconds, we'll watch the results come in, and let's see how you voted. So 25% of you used full funding as recommended in the engineering's reserve study. 53% of you used some form of threshold funding, and 22% of you include whatever you think you can afford in your budget. So let's move on to some discussion on replacement funding.
Okay, when you have a new replacement fund study, there's several things that you would consider. One of them is that the study generally gives you 3 types of funding: full funding, 10% threshold funding, and 5% threshold funding. Jules, I know that you're frequently asked as to what type of funding you would recommend. Do you want to briefly explain the different types of funding?
We could have a whole seminar just on funding itself, but basically the most conservative type of funding is full funding, where each component is evaluated as to how much it costs and the useful life. So if a roof costs $250,000 and lasts 25 years, we put in $10,000 per year. And what threshold funding basically does is set a threshold or a level below which you won't fall so that you are pooling the various components. 10% threshold is more conservative than 5%, and 5% is less conservative than 10%. And perhaps we'll revisit this whole concept of funding options in another webinar.
Okay. So as Jules discussed, some of the issues are how conservative you want to be. One of the other things you may want to consider is your cash flow constraints versus the benefit of the different types of funding. The one thing we would recommend that if you're choosing a 5% threshold funding, you may want to consider updating your replacement fund study more frequently. We would usually recommend every 3 years, or if you've done a major repair or replacement.
Okay, so we have a couple of audience questions that came in. One says, when an updated reserve study requires an extreme increase in funding, which your budget doesn't cover, what do you recommend? Well, there's no magic bullet here. There's no magic answer. A board basically has to balance its fiduciary responsibility for being able to set aside money to major repairs and replacements of the common elements with what a community can afford to do. So the advice is to try and raise the fees to a level that's affordable and have a long-term plan as to how to get to where the engineer thinks you ought to be. Another question that came in was on contingencies. You advise to budget 3 to 5% based on what? Amanda, do you want to go over that one again?
Okay, so when you're considering your contingency line items, what you want to look at is you want to come up with all of your expenses that are known. For instance, you know you're going to have landscaping, you know you're going to have items like an audit, for instance, or office expense. So you take all of those known amounts. The two things that you wouldn't want to consider are items like replacement funding or deferred maintenance funding. So when you take all of your operating expenses, look at that amount and use 3 to 5% of all of your operating expenses, and that's what we generally recommend for your contingency line item. Okay. Then continuing back with the replacement fund, as I have said, you want to consider the cash flow requirements versus the benefit of full funding or the various thresholds. And then lastly, if you're due for a new study, then that expense should also be included in your budget. You would want to consider what type of study you'd want to do, whether it's a full study, an update with a site visit, and you'd want to obtain estimates for the different levels of service, and that should be included in your subsequent year's budget. Moving forward to deferred maintenance funding. So the reason we have deferred maintenance funds is to help in smoothing out some of the large expenses that don't occur annually. So those items may be mulching, painting, or certain repairs and maintenance that are not capital in nature. So management or an engineer can help you with this, but once you determine which large expenses are incurred less often than annually, you would then need to determine how often those expenses are incurred, whether it be every 3 years, 4 years, 5 years. You take the estimated total cost, and then you divide the total cost by the number of years for replacement, and then that's what should be included in your current year line item.
So we got a question in the interim. How do you budget for multi-year capital replacement, such as roads? I'm going to give you the short answer, but we did do a webinar which is available on our website on that. But basically, it depends. If you have enough money in your replacement fund to pay for that, based upon setting aside monies and what the engineer says it's going to cost, then budgeting is really not a problem. But if you don't have enough money to be able to pay for it, then you need to look at either A, increasing the contribution to the replacement fund, B, some type of special assessment, C, the possibility of taking out a loan, or a combination of those three items. Back to Amanda.
Okay. And lastly, I'm going to talk about other sources of revenue in your budget. So when you consider other sources of revenue, things that you may want to think about are membership fees or working capital contributions. Maybe these amounts can be increased, generating some other sources of revenue for you. But we would recommend that you review your documents and consult your attorney regarding that. Some other areas is that the association may be able to have roof rental income. So for instance, if a cell phone company wants to come in and put an antenna on your roof, they may give you rental revenue for that. So that may be a way to generate income, or certain marketing fees if Verizon and Comcast want to be able to come in and they'll reimburse you for certain things. So those items may be other sources of revenue for the association.
So Amanda, other sources of revenue is a beautiful thing. Are there any tax implications to getting other sources of revenue?
Well, of course there's going to be tax implications. So regardless of the type of return that the association files, there are certain types of non-membership income that may be considered taxable income to the association, which would be those items like roof rentals. So when including these revenues in your budgeted income, you must also consider the tax impact, and you could always discuss it with your W&G consultant for assistance with the tax implications.
Okay, Amanda, that was terrific. While Jeff takes the hot seat, there was a question, do you recommend that the total reserve funding be at least 10% of revenues? And I think that the source of that question, or the root of that question, has to do with being approved with FHA so that your community can get FHA mortgages. So I wouldn't use 10% as a rule of thumb, but if reserve funding can be at least 10%, then you have a better chance of qualifying for FHA approval. There are other factors as well in that. So now I'm going to turn over the mic or the phone to Jeff. We've spoken about how you should budget. Now, how are we going to collect that type of money?
Okay, so collections is probably the single most important topic, or the most frequently raised topic from all of my clients. The collection of delinquent assessments is first and foremost on everybody's agenda. My recommendation to all clients is to have a uniform written policy. The most important thing when you're dealing with collections is to move quickly and to do the things that you're allowed to do by law on the first day that you're allowed to do it. If you stretch this process out, the amount of money that the association is owed goes up, and the likelihood of collecting goes down. By enacting a uniform written policy that we can do by resolution and approved by the board on day one when they retain my firm, then we don't have to go back to the board for authority each time we have to take the next step. That authority is granted in the initial resolution. Now, of course, we provide a status report every month to every client so that you'll be able to track what's going on. And, of course, we try to do payment plans at every stage throughout the process. But for those delinquent unit owners that are non-responsive and have just decided not to pay or are unable to, it's important that the attorney is able to move and move very quickly with the pre-established procedures. One of the bigger problems that we have also when we come into a new client is that perhaps nothing has been done for a while. And once the amounts get up to $10,000 or $15,000 or $20,000, those delinquencies become the least likely to collect, and the most likely to result in a foreclosure, which is generally in this market is a loss for everybody involved. The better thing to do is to get these matters over to legal counsel no later than 90 days. So if they miss 30 days, if they miss a payment, the management company typically sends a letter and a late fee. 60 days, they'll get another letter. Some associations do refer to counsel at 60 days. And we recommend that no more than 90 days goes by without payment before you send it to legal. If you put this process in, within a year or 2 years, you'll start to see your overall delinquency rate going down, and you'll be able to maintain it at a reasonable level, even in the bad market. When you slow up on collections, out of concern perhaps for legal fees or otherwise, you'll see your delinquencies go up and start to get out of control, and that's where we see the most difficulty for associations. One of the other benefits of having a good collection policy and bringing your delinquencies down which again may take a couple of years if it hasn't been addressed adequately, is to comply with the FHA guidelines. Now that's a double-edged sword. FHA approval is not for everybody. Basically what that means is that a certain market of potential buyers or lenders will open up and be able to come in with government-backed loans, generally those that are under 20% down. Some associations don't want people moving in for less than 20% because they feel they're more risky, so they choose not to go through FHA. And some do want to be able to offer FHA within their community because it opens up about a third of the market, and it makes it easier for you to buy and sell your unit, and it makes it easier for you to refinance. And that's a community-by-community decision that you should discuss with counsel. Of course, in collecting debts is also a fiduciary obligation, and I'm certain that in all of your governing documents you'll see probably in the master deed or declaration as well as the bylaws provisions that state that when a delinquent unit owner fails to pay, there's thresholds usually set right in those documents for when you are required to send it to legal. One of the things that you should do is review those policies. Sometimes those provisions are a bit outdated and can use some updating to allow things like late fees or interest and a more efficient collection procedure. Now I'm going to go through as briefly as I can the general collection process from beginning to end. This is a 101. I'm not going to go into a great level of detail, but I'm going to give you the basics. And if anybody has a question, my contact information will be provided at the end. And feel free to give me a call, and I'll be happy to discuss it in more detail. Everybody should understand there's basically two avenues that you can go with an attorney using the legal process. And one is to go after the individual for the money that they owe, and one is to go after the unit. To go after the individual, you typically file a lawsuit in the law division and then get a money judgment, garnish wages, and levy on bank accounts, which I'll go through in a moment. And the other method is to do a foreclosure where you actually look to obtain title of the unit. So let's start first on day one. The matter gets referred to legal. We send out a collection letter. If we get a response, we'll resolve it right at that time. If there's no response, the next step is to file a claim of lien. A claim of lien does something that we call cloud title. It puts everybody on notice that the association is owed money. If anybody were to lend this person any money or look to buy or sell the unit, when they pull the title work, this lien will be there, and they will realize that it has a priority, and it will get paid at any closing, or it will prevent the closing from occurring. So it prevents the unit owner from getting away, so to speak, and it protects the association. In addition, under the Condominium Act, when you file a claim of lien, it gives you a 6-month priority. We call it a super lien or priority over the purchase money mortgage, the first mortgage, so that if there is a foreclosure, then typically the association would get nothing because by statute we're subordinate or behind the bank, except for this 6-month priority. So you get 6 months of the then current assessment for that unit, which isn't great. You know, when it was enacted, that used to mean something. 6 months these days with the in the $10,000 or $15,000 or $20,000 loss, it's not a great portion of it, but it's better than nothing. And by filing the lien, you secure that. In addition, when you file this claim of lien, we also notify the lenders, and you can be certain that not paying your condominium fees is an event of default under your mortgage. And simply by filing the lien and notifying the mortgage company, they may put the unit owner into default of the mortgage if they don't pay the condo assessment. Occasionally, the bank will also pay us to prevent us from taking any further action, and then they'll add the money on to the mortgage and go after them themselves without us interfering. Before you file a claim of lien, you should accelerate your assessment. Acceleration means that the monthly fees that you pay are not actually monthly fees. It's an annual assessment that you often have the privilege of paying in monthly installments. So it's one of the things that should be in your governing documents, and it's in some but not in all, and if it's not there, it should be added, is that if a unit owner goes delinquent, they should be notified that the remainder of the year's annual assessment, which means all the monthly assessments for the rest of the fiscal year, will be deemed immediately due. So when you accelerate the claim of lien, and when you accelerate the assessment, you can put that amount into the claim of lien, including the attorney's fees that it would cost to file the claim of lien. If there's a bankruptcy, having a claim of lien also helps to secure your claim. The Condominium Act only applies, obviously, to condominiums, so the 6-month priority is not available for homeowners associations. But nevertheless, homeowners associations should also file a claim of lien very early in the process, right after the initial collection letter. The next step would be to go after the person and attempt to actually collect the money. The lien protects the association, but now we want to actually go get the money. if it's a matter that was referred to us early on at 90 days, this is the best route, is to go directly to the special civil part, which is a court that has jurisdiction for amounts that are $15,000 and under. It's kind of like a small claim. It moves very quickly. You could get out of there in 2 or 3 months as opposed to a year or 2 years in the regular law division. Typically, we file a complaint in the law division. I would say 95% of the time, nobody answers it, and the delinquent unit owner ignores it. Within about 2 months, a month and a half, 2 months, we should have a judgment. Now, if the unit owner files an answer, it may take a little bit longer, and there may have to be a trial. But ultimately, the requirement to pay your maintenance fees by law is deemed unconditional, and there's case law to that effect. There is no defense. You can't say that the landscaping wasn't done right, or that they didn't fix the roof and it leaked and it caused damage, so I'm withholding my maintenance fee. That is not allowed. Renters can do that. That's called the Marini defense. That does not exist in the condominium world. The condominium owners are just that. They're owners. They're not renters, and they have to pay the maintenance fee, and it's unconditional. So while occasionally we do get an answer and people raise these defenses, invariably they fail, and the association gets its judgment in short order.
So, Jeff, a couple questions came in while you were speaking. One question is, do these liens have to be renewed every 6 months or periodically?
Well, that's the reason that you accelerate the assessment. It's called updating a claim of lien, and it would work like this. Say you file a claim of lien today for $5,000, and a year goes by and they owe another $10,000. You would file an updated claim of lien for the remainder. At that point, you would have a lien for the full amount, but $5,000 would be have a priority from the day that you filed it, and the updated claim of lien portion would have a priority only from that day. So if anybody filed a lien in between, they may have a priority over the updated claim of lien. It's first come, first served, with a few statutory exceptions for municipal liens, taxes, and purchase money mortgage. But the idea is, yes, you would update liens on occasion. Typically, at the beginning of the fiscal year, you would just reaccelerate for the whole rest of the year and then file an updated claim of lien. So typically, you do that once a year if you have acceleration.
There was one other question that came in. Somebody asked, should board members try and collect monies that are owed to an association?
There's absolutely nothing wrong with that. Some attorneys may differ, but if you have a board member that goes and knocks on somebody's door, and perhaps their neighbor that they're friendly with and wants to sit down over coffee and figure out a way, I'm not necessarily against it. I would prefer that they told me about it and discuss it with me if they're going to do that, so that I can caution them that everything they say may end up in court and could be deemed a representation of the board and binding on the association. But often that's an effective method as long as it's done under the advice of counsel and cautiously.
Great. So let's move forward.
Okay. Now you have a judgment in the special civil part, and now you have to collect it. There's a few ways to do that. Number one, you could send out an information subpoena, which is a document that the unit owner has to fill out and tell you where all of their money is. Now, believe it or not, most unit owners don't tell the truth about where their money is. So the information subpoena is often not filled out, or it's filled out incorrectly by leaving out bank accounts and leaving out other properties and other assets. Now, we have the option of filing a warrant for arrest and having the unit owner arrested, brought to the courthouse, and they can fill it out. And we do that on occasion. It's definitely an option. But what I generally recommend is that you consider hiring an investigator rather than going through the warrant for arrest. Warrant for arrest certainly generates legal fees, and that's always good to a lawyer. But it's more cost-effective often for an association to go right to an investigator, which we work with several, and do a bank search or an employer search right off, rather than relying on the unit owner to provide accurate information. If we most of those are no-hit, no-fee, so it may cost $300 or $350 to find a bank account, and if none are found, you don't pay the fee. And if there is a bank account located, you pay the investigator, and then you add that cost into the amount that the unit owner owes. If we find a bank account, we file a motion to go take any money that's in there, gone through the sheriff. And if we find a job, we'll garnish wages to the maximum amount permitted by statute. That's the way to recover money. If they have other properties, in addition to the unit, we can also, through the special civil part, ultimately put that unit up for sale and attempt to collect that way as well. Although that's typically done through foreclosure, it is possible through the law division.
One more question on liens that came in. If an association considers, quote, a secured lien holder, unquote.
I believe that you're probably referring that to bankruptcy. In the bankruptcy, it depends, and I'll speak about that briefly in a little while. Most of the time in a bankruptcy, the association is going to experience some loss. There's going to be other liens ahead of it, and primarily the purchase money mortgage is always ahead of condo lien because that's the mortgage that was there on day one. So in these days, there's usually negative equity, which means that the mortgage lien is worth more than the unit is worth, and we're subordinate to that. So being a secured lien holder often is not in a bankruptcy action. It's not going to get you very far in the current market, but by filing a lien, it does help secure your interest in the bankruptcy. There's a process that you could follow in the special civil part called docketing the judgment. When you docket the judgment, you send it into Trenton, pay about $40, $50, and the judgment becomes a statewide lien on all real estate, which means it's a lien on not only the unit within that condominium, but on any other properties that that person may own in New Jersey. When you do that, it transfers the matter from the special civil part to the regular law division, and the procedures for recovery are a bit different. Unless, our general advice is, unless that the association is aware of other properties in New Jersey that the unit owner has, it's often better not to docket it right away and keep it in the special civil part where the collection process is a little bit easier to work through the court system. One of the best methods that we have of obtaining a bank account is calling up the management company and seeing if the unit owner is paid anytime within the last year or so. Because if the unit owner paid with a check, it has all their banking information right on it. So before we do anything, as soon as we get a judgment, if we have a copy of a check, we'll use that and attempt to levy on that bank account first, and often we're successful early on by doing that. If the special civil part is not working, if you haven't obtained a recovery, if there's no money, the person just doesn't have a bank account and doesn't have a job that pays enough or doesn't have a job at all in order to qualify for garnishing wages, at that point there's not much else you can do. You have the judgment. You can docket it or not. It's still going to be a judgment for 20 years that's renewable. And if the person, you still have the claim of lien. So if the person ever gets back on their feet, you will recover if they ever try to buy or sell another unit. If that doesn't work, you would move on to a foreclosure. I'm not going to go through the whole process because it's very lengthy, but what a foreclosure basically is when you have a lien, you can foreclose on and actually take title to the unit. And there's a lot of things to consider before doing that. You have to look at the title report, do an equity analysis, which between your attorney and management, they can help you do that, and decide whether it makes sense to foreclose, knowing that often the money you spend on a foreclosure for an attorney, you're not going to recover, but you will get rid of somebody who's not paying. So if you have an absolute deadbeat, sometimes foreclosure is the only method of recovery. And everybody should know that there's a lot of upheaval in the banking industry. Some banks are moving and some aren't, and that has an effect on whether you should file a foreclosure as well, and that's something that you should discuss with counsel. Very often what we're seeing these days is people get in the hole for $10,000 or $15,000, and then by that point they're too far gone and they file for bankruptcy. There's two kinds of bankruptcy. There's Chapter 7, Chapter 13. If they're filing Chapter 7, that means that they're out of money and they have no income or not enough income to pay their current debts. At that point, all their assets are going to be taken from them, liquidated, and spread among the creditors. And the association, in all likelihood, is not going to recover very much, but the unit owner will, more often than not, be gone. The unit will be taken if there's equity. Now, in these days, when there's no equity, even in the Chapter 7, the bankruptcy court, it's called the trustee that they appoint, will abandon the unit, which means put the unit outside the foreclosure because it has no equity. At that point, even with the bankruptcy pending, the association and the banks can still foreclose on the unit and push the person out. Chapter 13 is reorganization, similar to a Chapter 11 for a corporation, where the person has income. They just need to kind of stop everything for a little while and get a handle on it. And under Chapter 13, there'll be a payment plan to pay everybody back. And sometimes it's at 100%, sometimes it isn't. And there's a plan, a payment plan essentially that is submitted to all of the creditors, and we would have to discuss with the client whether or not it makes sense to object to the plan or if we're okay with it. Also keep in mind for bankruptcy, once a bankruptcy is filed, whether it's 7 or 13, the unit owner still has to pay all the fees from that date forward. It only puts a stay or a limited hold on the fees from that date, the date that they filed that petition, back. So if the person doesn't pay the next month's fee, we're allowed to go ahead and try to collect on that.
Jeff, a couple of questions came in, so let's try and address a couple of these briefly.
Sure.
This might be a tough one for a lawyer who does some collection work, but one of our listeners asked, Do you recommend the use of a collection agency to try and collect the past due fees?
I mean, to me, if you could find one that's willing to do this on a contingency, then, knock yourself out. In order to find any collection agency that's willing to do, for instance, the foreclosure, which going into the foreclosure that you have close to a 0 chance of recovery. The purpose of a foreclosure is not to recover in this market because there's no equity. It's to get the person out and get somebody in there who can pay from that day forward. Because losing money every month is the same as spending money. So it's important to get that delinquent person out if they're beyond recovery. Now, how can anybody take a case where it may cost $4,000 or $5,000 over the course of 2 to 3 years with no chance of recovery? How can you take that on a contingency? So if a collection agency tells you that they're going to do the work that you're required to do, I don't really think that they're telling you everything that they're supposed to be telling you. Also, most of these collections are for a lower amount, and the amount of legal fees often is it could be 25, 35, or sometimes 50% even of the amount that's owed, particularly if you do the right thing and start early. So that if you go to court and you're owed $2,000 or $3,000 and it costs you $1,500 to get there, there's nobody that's going to, at least in my experience, there's no attorney that you'd want to use that would take that on a contingency fee basis. So I don't think that there's a realistic option of using a collection agency.
So if you have a different topic, if you have a unit owner who doesn't live in the unit and they're renting it out, and that unit owner is delinquent and the tenant is paying rent through a real estate broker, is there a way to direct the tenant to pay